Hi, I'm David Humphreys from Property Investor Mastermind, and this is the first of a series of tutorials on how to operate, how to work with the Investment Property Analyser, which takes the guesswork out of property investment. And now I'm going to move on to the first page of the Investment Property Analyser. And so we come to the Investment Property Analyser disclaimer notice. And before going into detail on this disclaimer notice, I must just stress that this is an unscripted tutorial and it has a number of ifs, ums, buts, etc. in it, and I apologize for those in advance. Okay, so let's look at this disclaimer notice. The calculations and analysis tools provided in this workbook do not, and I stress not, constitute advice, but are provided for guidance only. Okay, we have though extensively tested everything with the relevant authorities and professionals, but particularly in the case of the tax return split, which comes probably in the next tutorial, you are strongly advised to seek advice from a qualified chartered accountant before submitting to HMRC or Her Majesty's Revenue and Customs. Also, to ensure accuracy of all your calculations at all times, you must keep preloaded variables up to date, and these include in the deal analyzer the stamp duty levels, in the refurb calculator contractor rates and material costs, and in the tax return split the proportion of revenue for certain lines. Now, we also recommend that you always have what we term as a virgin copy of the workbook, one that has not been used. And it's best to save it as an Excel template, and the instructions as to how you do that are typed out here. Okay, so you take your original version or your virgin copy, you make a copy of that and you use the copy of that. Okay, and you repeat that copy. And now I'm going to move on to the second page, but the first working page of this analyzer, which is the deal analyzer. And here we are. This may look like a very comprehensive and complex spreadsheet, and it is, but let's put the cursor where the start position is. Although there's a considerable number of variables in this spreadsheet, you will not be repeating these variables or changing them every time you use it. Okay, and I'll point these out. So once you get used to where things are, once you get used to working through this, it's easy to get to a point of what your maximum offer price should be within 15 minutes. In fact, you can probably do it faster than that, but let's look at them. Now, the analyzer says start here. Not strictly the case. You should start over here with property address, or possibly even here with date. That's probably the most important one, date. Property address, city, postcode, brief description of what the property is, then you come into this area. And we say start here because it's putting the market value into the property, which effectively brings this analyzer to life. And it's the market value that triggers off the maximum offer price. Okay? I'll come back to this section, the purchase variables, in a minute. I'm going to go across and start with the mortgage variables. Now, as I said at the beginning, you're not going to be changing everything on every single occasion. So we start off with the mortgage LTV. So it's set at 75% in this example. By the way, I've populated this deal analyzer right the way through to show you how it works. And in most cases, if you're operating at 75% LTV, you won't change this number in the next property or the second, third, fourth property. Likewise, the mortgage interest rate probably won't change on a property by property basis, or will the initial mortgage period. Okay? if you are going to stay with the same lender and possibly with the same mortgage, or more relevantly with the same lender and the same mortgage, then these variables again won't change necessarily. That is the application of booking fee, the arrangement fee, the legal fees, and the valuation fee. And that gives you a good example as to why it's possible to work through this analyzer certainly within 15 minutes, because a lot of the variables will not change every time you look at a different property or you analyze a different property. Now, a feature of the analyzer is the ability to switch on and switch off certain costs. So here we have the possibility of adding any of these costs to the loan or not, as the case may be. And in this example, we've added the arrangement fee to the loan of £1,500, reducing the cash or the mortgage related cash costs from £2,500 to £1,000, having deducted £1,500. And it's the £1,000 that's taken across to this cash area here, and as you can see, mortgage related fees are set at £1,000. Now, before I go any further, I should explain that all these light blue cells are data input cells, and the white cells are AutoCalc cells, which you can't in fact get into, but you put the information into the light blue cells throughout the analyzer. So this deals with the mortgage variables, and then we move on to stamp duty variables. I'll try and keep away from the labels that have these comment boxes. Okay, I apologize in advance for flashing these up. Anyway, this is one of the set of variables that you need to keep up to date. They're not going to change very often, and when they do change, you make the change, and that's it for maybe months, maybe years. You can turn stamp duty on or off dependent on whether you are in a stamp duty location. If you're in an area which is exempt, you switch it off. If you're in an area which is not exempt, you switch it on. The calculation of stamp duty based on the maximum offer price is an AutoCalc, and is carried forward into the cash cost, because stamp duty is always paid in cash. Okay, you can't roll that up into a mortgage or something like that. Okay, so it's an AutoCalc area, and it's picked up. We then come into other costs that may relate to the cash requirement. Okay, so once again, the costs here are brought into the cash requirement over here, total other costs. Now I'll just run through them quickly. You've got the survey costs, other costs, whatever they may be. We've identified lease extension as a cost. That's where you buy a property which has maybe got 10, 20, 30 year lease left, or 30 years of lease left, and it's agreed that before you purchase a property that they will extend it by a further period up to, let's say, 100 years. And then you've got division of title costs, and this is where you buy a property which is already split into flats, or can be split into flats. In other words, you buy one dwelling unit which can be split into more than one dwelling unit, and you divide the title between the 2, 3, 4 dwelling units that are either created or have been created. There's a cost involved there. So that is other costs that we've identified, and you bring the cash costs in, which increases the cash required total. The next panel of variables is bridging finance, and once again you can either switch it on or switch it off. In this case it is switched off, but bridging finance is particularly useful when you're buying at auctions, because it's unlikely that you're going to be able to get a proper mortgage through in the 28-day period, or sometimes it's 14 days, but generally the 28-day period between the auction day and the completion day. And so bridging finance is a very useful source of funding for purchasing at auction. It's also a very useful source of funding if you are doing a deal on a property through private treaty which requires a rapid completion, such as chain mending and stuff like that. In any event, bridging finance itself is covered in our tutorials Bridging the Gap, which is specifically about bridging, and also references made to it in our auction tutorials as well. So here we have the LTV, the loan amount, interest rate, the period of bridging, which is generally 6 months, any exit fee, application, valuation and arrangement fee, legal fee and interest payable. And once again, you can switch on or off as to whether these fees are added to the loan. Okay, so it's multi-flexible, and then you get the total cost including the exit fee. Now we come to the flip calculator, and for this to work you have to switch off the remortgage, which I will do now. So you put an N into the remortgage drawdown, and that brings the flip calculator to life effectively or accurately. And what you've got here is the ability to put an asking price in. Remember, all the blue cells are data input cells. Asking price, accepted offer price, legal costs, redemption fee and the EPC. You enter the agency fee and it works that out on an autocalc basis and gives you the currency sum, or the sterling sum if you're working in sterling, and then finally works out the gross flip profit. Okay. Now we come to the purchase variables, and as I said, it's the market value, excuse me on that one, it's the market value which triggers off the analyzer. So you've got an asking price, which you put in as data input, the market value, which I've set at 150,000, and what you're looking for is a 20% discount. That's the desired discount. And once again, if you were always operating on 20% discounts, you wouldn't change that on every property. You'd leave it as a sort of standard figure. Okay, it automatically works out the deposit, and this deposit is carried forward into the cash area over here. It works out the maximum offer that you should be making, and you can then enter later the actual price paid. And obviously, if the actual price paid is entered, then all the monetary calculations are based on that actual price paid. Next on the list is the renovation summary, and this is brought forward from the refurbishment calculator, which is the 4th page in this analyzer. So this is just summarizing what I have preloaded into the renovation or the refurbishment calculator. And we have the project weeks, the total renovation cost, and the mortgage cost during renovation. And if we had switched on the bridging, it would also include the bridging cost during renovation as well. But you're unlikely to have a mortgage and a bridge. It's basically one or the other, because you would bridge until you got the property fixed up, then you would remortgage it and pay off the bridge. So we then come to the remortgage or drawdown. This is switched off at the moment because we've switched it off so that we can look at the flip calculations. But I'm now going to switch it on. As you can see, I've preloaded it with some information here in the blue cells, but here we've got a white cell. This is an autocalc cell. It's not working because this is set at N. If I set it at yes, then this little panel will come to life. There we go. Okay, so it shows that we can raise a remortgage amount of £131,000 based on a value of 175,000. this cell automatically reads this cell here, but can be overwritten. So we started off with a market value as it stood of £150,000, and then we've carried out £13,000 worth of work, and the result is a property value 6 months down the road of £175,000. If we didn't overwrite that, this cell would read the 150 from this point in the purchase variables. Okay, but we've overwritten it, and the result is that we've got a remortgaged amount of £131,250. Next we come to the rentals, and here once again you won't be changing these variables on every property, or it's unlikely. So if we take the first three variables, voids, which are expressed as a percentage, the letting and management fees, again a percentage including VAT, and annual repairs and maintenance. And then over here we've got the weekly rent, which I'll come back to in a minute, and the annual insurance, which is a currency figure expressed as a sterling figure. Now this panel here, properties single and multi-let, allows you to list a number of properties, but all these properties would be at the same address. So I've set it up as a two-bedroomed terraced house and one single unit. That's the way it's been preloaded. But assuming that I had bought a property which could be split into, let's say, 3 two-bedroom flats, I would simply put the rent in that I was going to get, and assuming that the rent remains the same across all 3 flats, and change that number to 3. Bingo. Okay. Obviously one would have to adjust the insurance probably on that basis. And this brings me back to an earlier variable, which was the division of title, because I might have bought a property which I can split into 3 flats, though the cost wouldn't be £13,000, it would be substantially more than that, and then divide the title up. So I'm going to put this back to 1 to carry on and explain then what happens. But this allows you to have mixed flats, studios, bedsits in a single property and look at them individually. When you come to work out the refurb calculation on them, then it's a single sheet, and therefore you'd have to double or treble up. So if you had 3 flats as an example, that would be 3 central heating systems, 3 kitchens, 3 bathrooms. And then we have the summary over here, gross rent on a monthly basis. The voids are taken into account, so the rent is reduced by the amount of the voids. And then the monthly costs, net of voids, letting and management. So the reduced rent, the letting management fee is calculated on the reduced rent, the repairs and maintenance, insurance, and the net monthly rent. And then that's annualized. Running down the third column, this is the analysis of the cash, and the only 2 cells here, data input cells here, are the conveyancing fees and sourcing fees if you're paying a sourcing agent. Everything else is auto-calc from another part of the analyzer. It gives you a cash summary. This is, as I said earlier, is to do with the renovation work, and this is brought forward from the refurbishment sheet. Okay, so in fact, and I'll just come over here for a second, you've got a cash burn on the project which is £44,798 in this particular example, and that is the total of this purchase related cost of £29,813 plus the £13,061 of renovation costs. Those are the 2 cash summaries effectively. We then come down to the monthly mortgage payment of £376 and finance payments over the period, which is over here. So we're financing for a total period of 6 months. Here we are. Initial mortgage period 6 months. So that is the total mortgage payments for the period set under the mortgage variables. We then have the cash position following remortgage. We've got the remortgage open here. So cash received is £41,000, Equity in the property left is £43,750. The net cash on completion, this is the cash that you will have to invest or leave in the property on completion, is, it says minus £3,736. It is £3,736. If this turns red, it means that you're leaving cash in the deal. If it turns green, it means that you're cash out of the deal. So if we, for instance, were to take this up to £185,000, probably turn that cell green. Yes, there you go. Okay, I'm going to go back to 175 for a moment. £1,000. There we go. So it says that having completed all the renovation work and remortgaged the property, you're leaving just under £4,000 in the deal. Okay. To come down this column, £100,000 is your cash available. I've explained what this cash burn is, the combination of this number, purchase related costs and total renovation costs. If you could do 2.2 deals with this amount of cash burn on each property. The monthly cash flow in this particular example is £748 as monthly. The capital gain is £56,750. The yield is 8.88%, or just under 9%, and the return on cash invested is 416%. This is the cash on cash return, and that is £15,000 annually as a percentage of £3,736. Okay, now if I raise this to 185,000, then this figure becomes infinite, because this goes green, which means I've done the deal, and having remortgaged the property, I have received an extra £3,764 from the lender. The result is I've no money left in the property at all, and whilst the yield remains the same, the cash on cash return, or return on cash, becomes infinite. And this concept is fully explained in our tutorial for renovating for profit, or forced appreciation. Okay, that brings me to the end of this first tutorial. So I'm going to close this one down. We're running at 22 minutes now. Close this down and then move on and look at the future and other features in this analyzer. Thank you for listening and watching. I hope you found it interesting, and I hope you will join me in part 2. This is David Humphreys saying thank you, and see you in part 2.